risk factors. This will be a little bit brief, but your responsibility, as usual, to ask questions. But these may be things like rising interest rates, rent growth assumptions, local economic exposure, and these are sometimes tucked away on the slide near the end. But as usual, should not be skipped. Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. All right, when you go on Instagram, you're checking things out, maybe a magazine, I don't know, wherever you're looking at today, and you see that stunning hotel promo, maybe that, luxurious bungalow, whatever it is. It's glossy, it's full of promise, palm trees, infinity pools, exotic drinks, the works. You know what I mean? You flip through it and you immediately start imagining yourself there. Well, in the world of real estate, private real estate investing, the pitch deck is your version of that brochure. It's meant to help you imagine, what if I invested here? What could this do for me? But just like that location brochure, the pitch deck doesn't tell the whole story. And today we're going to be breaking down what you're actually going to find in a pitch deck for something like a multifamily real estate syndication. At least that's what we're going to be talking about for today. But you can use what you're going to learn today to think about this for other assets, syndications, or funds, whatever. And you just want to look out for this so that you can really determine what you're trying to determine is, do you want to take the next step? It's a pitch deck, anyway. This episode is a part of that this mini series on the real estate investment materials. I thought it'd be a good idea to do this because, many of you have never invested before, and well, it's like, what do you even expect to get on your documents, right? And so I've already released one episode already on this mini series that walks through the private placement memorandum, or PPM for short, which is that formal legal disclosure document. But here we're focusing on the more of that marketing forward, the high level version of the deal, the pitch deck, sometimes called the investment summary, the deal deck, offering memorandum, which is used more loosely in some real estate circles. And so, um, where does this pitch deck fit in? When you're valuing private real estate syndication, especially under the Reg D 506B or 506C offering, you'll typically see the following documents in this order: the pitch deck, the investment summary, right, or executive summary. And this is the first piece that you're going to receive, right? It's the marketing focus, gives you the big picture. The second document is that private placement memorandum, the PPM. This is a legal disclosure with all the risks and legal structure. And then third is that subscription agreement. This is what you're actually going to sign when you invest, and what you need to do so that you can sign that, and then you're going to wire funds. Right? You may get this last one, but what this is kind of that fourth and optional. It's still good to really see, and I would always ask for it, is the operating agreement or company agreement. This defines how the entity is run and how the profits are distributed. The pitch deck gets you interested, the PPM confirms the reality, and the subscription agreement and operating agreement locks in those actual terms. So let's zoom in. What do you actually find in the multifamily pitch deck for something like the syndication? So let's break this down piece by piece, and a few examples here that which you're actually going to see. And this is kind of just the big picture here, to give you a section by section. And so the first one is the property overview, right? Example of this would be, the name of this property. You've seen this before. Maybe you've even lived in an apartment or a multifamily complex like this. You're going to see something like, Lakeside Gardens, a 192 unit Class B property located in the suburbs of Austin, Texas, built in 2002. The sponsor is acquiring the property off market below replacement cost. It includes things like the photos, a map, bullet points for the properties, physical details, just like that. So you're going to see things like the map, the location, right? And the map and the market snapshot. Market snapshot, something like located 15 minutes from downtown Austin with a top rated school district and 5 minutes from Tesla's Gigafactory. You'll see the heat maps like proximity to employers, local growth stats. And these are kind of things like landmarks to kind of give you an orientation as an example. Okay. After that, you're going to see something like the business plan. You're going to see them say it like, we plan to renovate 60% of the units over 24 or 30 months or whatever it is. And we're increasing rents by an average of $150 per unit while maintaining 95% occupancy. And you're looking for clarity, whether it's something like a value add or core plus or opportunistic. And these are just different ways, different strategies on what the business plan is, right? If you need more information on those things, I have a whole different episode there about that, the value add, core plus, opportunistic, so forth. But really, you're going to see a lot of those deals because it forces the appreciation, so to speak. It forces it. You're able to renovate and raise the rents. All right, because here our example was plan to renovate 60% of the units over 24 months. So that's what that's kind of talking about, value add. Next, you're going to see something like, and it may not be in this order. You might see this, really a bit earlier, but the sponsor team, like leading with the sponsor team, ABC Capital has acquired over X number of units since a year, and with a weighted average of, an IRR or returns of whatever it is. And really, what you're seeing here and what you're looking for as an example is something like, what has their track record been for what kind of returns have they got for investors? You might see something like, just like I talked about, in the last 5 projects, it was this amount of returns and this amount of returns and this amount of returns. It's like, okay, cool. So they've done this. And importantly, they have experience in this type of business plan as well, this type of asset, whatever it is that you're looking at. Another thing here, next, you're obviously thinking about this. It's a pitch deck anyway of, well, what are the projected returns? Like, I get the asset here. Okay, I got that check. It's going to be 192 units for this example. I know where it is. Cool. Check, check. It's near, it's in suburbs. It's built in this, this year. It's near a gigafactory. Amazing. It's got nearby some top rated school districts, and I understand the business plan. Okay, cool. Awesome. And I also understand who's the team bio. Perfect. And now you're probably wondering, okay, let's get to the good stuff. The good stuff being like, what are the returns? So you're going to see something like the projected returns, right, are, should read something like this: projected returns of X, IRR with a, uh, in this case, I've just made some stuff up. So the example is projected return 7%, preferred return 14 to 16%, IRR, and 2x equity multiple over 5 years. I know if you're brand new to this, it's kind of a mouthful, but the point is you want to see something like this so that it is very clear, right? These are what they expect to get, projected returns. I'm not going to go into detail here about, things like a waterfall or the ways that the returns are provided out and distributed to the GP team and the LP team. But just know that you're going to see this on the structure because, well, if you're investing in something, you would hope that you're getting that, right? And so that's the returns, and as well as the deal structure would be here too, right? You're going to see things like different share classes, an example. You're looking to invest, so there's going to be something where maybe if you're investing 50,000, you would have one share class, where 100,000 gets another share class, or 250,000 gets another share class. And each of those might get different returns because the sponsors, want to incentivize higher investment amounts, right? That means they get the deal funded. The investors, they get what they need. The investors will get what their return structure they're happy with for the amount they invest, and everyone gets a win-win. And it's up to you as the investor to look at this and determine,
is this something that I can live with? Is this something that I want? And does this make sense based on the return profile and the risk profile and the sponsor profile as well? Okay, so what else you're going to see here? Next thing you want to make sure that you're seeing here is cool. I understand the asset, I know the team, I understand the type of business plan, the deal structure, what I'm investing in makes sense. What else? How are they doing this? That's the thing. The business plan is one thing. The other thing is the exit strategy, right? So, an example of this, if it's something like, maybe they're doing that value add is cool. They did the value add. Maybe that took 24 months and they plan to refinance in year 3 or year 4, right? Maybe they want to refinance and then they want to hold up until a target of about year 5 when they would like to sell, but contingent on the market, right? Because if it's not a good time, then maybe they hold it for another year or two. But the point is that you want to understand what are they trying to do with this thing, and what is that business plan, and that's why this falls under the exit strategy. And so the question really is this aligned with your preferences? Are you okay with them exiting at year 5? Or if they say, hey, if it's right and we're good to go, we're going to exit in year 4 instead. So these are just things that you want to understand. Okay. Next thing in here is risk factors. This will be a little bit brief, but your responsibility, as usual, to ask questions. But these may be things like rising interest rates, rent growth assumptions, local economic exposure, and these are sometimes tucked away on the slide near the end. But as usual, should not be skipped, right? What are the downsides? They gave you the upsides, right? But what are the downsides as well? So at the very end, the question is okay, if this is something you want, it's piqued your interest, you got all your questions answered, and it makes sense, well, then, there's an understanding here of timeline and next steps. So it's kind of when the capital is due, meaning like when you have to fund it, estimated closing costs, and of course, how to wire funds. And so that's kind of the big picture for the pitch deck that you're looking at when you're looking to invest. All right. So great. This is the big picture of these things. So you're probably wondering, like, what are some of the questions that might be asking after reviewing this pitch deck, or really as you're going along, right? It's good to have a checklist, right? So it's not just, are you emotionally invested? Is there so much hype that you're going to say, great, I want to invest in this? There's not, but you want to go through some of this framework, these questions to think about this, right? Because a good pitch deck should leave you with confidence, not confusion. You should add more information so that you can determine for yourself, not is this a good deal or bad deal, but is this a good deal or bad deal for you, right? Just to be super accurate on that. Maybe it's an absolute bad deal. It's a terrible deal for investors. But the only way you're going to know is you're going to get some reps in by looking at a bunch of them and asking questions. So here are a few common and I would say smart questions just to get started uh, with reading this pitch deck. And of course, add your own tool belt with these, but these are just some to really think about. Okay, as usual, are these return projections based on actual comparable properties in that same submarket? You should go and see what those comparables are. And if it's not already very obvious, if you didn't see 4 or 5 or 6 or 10 other properties where they've talked about, hey, just down the road, based on the same square footage and same type of unit mix, a 2 bedroom, 1 bath, this is what we're expecting. It's near the same vintage, the same year the property was built. And this is, there are things that are very, very similar, just like the property that's in the pitch deck, as an example. All right, so that's one thing. How much of the sponsor's own money is going to be in the deal? Like, how much is the what's called the co-invest? Are the people that are offering this up, are they putting any money in the deal? This is useful because what it shows is alignment. All right, if that's something to ask, and ask how much. If you got to ask some of these questions that might feel a little bit uncomfortable, but transparency is absolutely key. And if you're asking questions just like that one too, and it's not anywhere to be found, right? Then some of the orange lights should be showing up. Yellow light, right? What happens if renovation costs go over budget? What happens if certain things go over budget? What happens if some of the conditions that they've been planning for don't actually go the way that they expect them to? And that's why team is so important, because you want to make sure that they've gone through this before. They know that, hey, there's a bunch of assumptions here based on what they're planning to for their business model, but they've done stuff like this, and kind of check in with those answers too. Right. So, what happens if things go over budget? Because they can, it's happened, will happen again. How are reserves handled in this deal? Cash reserves, as an example. What is the minimum investment? Is there a wait list if it fills up? That should be obvious on there too, but kind of check in. Sometimes they'll offer things less. That's just kind of up to you. And it's good to get some of these questions in there, and also listen for other people if you're on something like a webinar or something else, to hear these questions being asked as well. All right. Um, a good one that I early on have learned to ask is, what is the communication like? Do you plan to communicate quarterly, monthly? What are those? And if I have questions, who can I reach out to? Right. So make sure that there is a recurring cadence for updates to be on. How do you get updates? It's your investment after all. It's a private investment, but you want to know that you have people that you can reach out to. All right. So that's the how frequently can I be updated once I invest? And, always good to ask, what is the tax situation? Okay. Will I receive a K1? Of course, that should be pretty well yes. But, what is the tax situation? That's going to vary based on a number of things, but just ask that. And yeah, these are just some starter questions. There's, a bunch of others. And if you want more of these types of questions, please, you can just reach out to me, connect with me on LinkedIn, shoot me a message and just say, hey, evaluation questions, or just type questions. And, I'd be happy to get you some more and talk through what some of these things look like. And so here's the thing. If you're reviewing a deck and none of these questions are addressed, or some of them are kind of partial, it doesn't necessarily mean it's an absolute bad deal, but you want to ask them directly before you're proceeding. This is your money. Take responsibility, take ownership. And so that's pretty much the point, right? And so with that, if you've ever looked at that deck and thought looks great, but I'm not sure to ask what next, then you have some things here. These decks are meant to spark curiosity, but for many new people, they can also just be overwhelming, because it's like, what do I pay attention to? Right. So with that, if you want to go over real life examples, you want to look at, some examples of decks on investments, something you can use to get more familiar with the structure of these, just reach out to me on LinkedIn or shoot me a mail, and just type the word pitch. We'll make that easy. We'll just make it pitch. And I'd be happy to send over samples, or even jump on a call with you or a recording, whatever works for you. And if you're not already on the newsletter, subscribe at retacapital.com. Go there and you'll get tips just like this, and some simplified things as well. And learn more about some of the investments that are coming out, so that you can see maybe some other examples as well. So as usual, thanks for listening. Stay tuned for the next part of the series. We're going to dig into the parts of the subscription agreement and what it actually says and what you're signing, and why that's so important too, because that is the one that's legally binding. And that will be closing out our mini series 3 out of 3. Thank you so much, and I'll see you on the next episode.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.